The stock market hit record highs last year. The average retail investor underperformed it. Again, this happens almost every year. Not because retail investors are stupid, because the market was not designed for them to win. Think about the last time you heard that the stock market had a great year. Maybe you felt it. Maybe you did not. If you did not, you are not alone. Research consistently shows that the average retail investor, the ordinary person investing their own money through a brokerage account, significantly underperforms the market index over almost every meaningful time period. Not slightly, significantly. In some studies by 4 to 6 percentage points annually, compounded over 20 years. That gap represents an enormous difference in final wealth. And the reason for the underperformance is not what most people assume. It is not stupidity. It is not laziness. It is not even bad luck. It is structure. The market was built with a specific set of participants in mind. Those participants have tools, information, speed, and resources that retail investors do not have access to. And those advantages compound over time, just like money does. By the end of this video, you will understand exactly who the market was built to serve and the one approach that actually works for everyone else. Most people think of the stock market as a place where you buy shares in companies and those shares go up over time. That is partly true, but it is the surface. At its core, the stock market is a continuous auction. Every second of every trading day, buyers and sellers submit orders for shares. Prices move based on the imbalance between buying and selling pressure. When more people want to buy than sell, prices rise. When more people want to sell than buy, prices fall. This sounds simple, but here is what makes it complicated. Not all participants in that auction have the same information. Not all of them have the same speed. Not all of them are playing the same game. Institutional investors, pension funds, hedge funds, investment banks, proprietary trading firms operate with resources that dwarf anything available to a retail investor. They have teams of analysts studying companies full-time. They have access to data, feeds that update in microseconds. Some of them have servers physically located next to stock exchange servers to reduce the time it takes for their orders to execute by fractions of a millisecond. This is called colocation, and it is entirely legal. The advantage it provides over a retail investor checking their brokerage app on a phone is not small. It is structural and permanent. Now here is the second thing most people do not understand about markets. Prices do not always reflect fundamental value. They reflect the collective psychology of all participants at a given moment. Fear, greed, momentum, narrative, rumor. These forces move prices just as powerfully as underlying business performance. And retail investors, who typically enter the market when confidence is high and exit when fear peaks, are structurally positioned to buy high and sell low, not because they choose to, because their emotional response to market conditions is human and predictable. And institutional players are on the other side of that trade, waiting for it every time. Now let us talk about the structural advantages that make the market systematically favorable to institutional players, because this goes deeper than just speed and data. Start with information access. Public companies are required to disclose material information to all investors simultaneously. This is called Regulation FD. In the United States, fair disclosure. It exists specifically to prevent companies from giving institutional investors advance notice of important developments before retail investors hear about them. In theory, this levels the information playing field. In practice, it does not. Institutional analysts spend their entire working lives studying specific companies and industries. They build detailed financial models. They attend industry conferences. They speak with suppliers, customers, and former employees of the companies they cover. All of this activity is legal. All of it produces an information edge that a retail investor checking quarterly earnings. Releases cannot match. The second structural advantage is cost. Every trade has a cost. Bid-ask spreads, transaction, fees, market impact. Institutional investors trade at dramatically lower effective costs than retail investors because of their volume and negotiating position over thousands of trades. Over years, cost differences compound into significant performance gaps. The third is access. Some of the most profitable investment opportunities are simply not available to retail investors. Pre-IPO company stakes, private equity deals, venture capital positions, institutional debt markets. These markets exist alongside the public stock market, but are accessible only to accredited investors and institutions with minimum investment thresholds that exclude almost everyone. The public stock market is not the whole investment universe. It is the part of the investment universe left over after institutional players have taken the positions unavailable to you. And then there is the final structural advantage. Time. Institutional investors operate with mandates that allow patient long-term positioning. Retail investors operate with their own psychology, their own fear, their own greed, their own need to see their account performing well in the short term. That psychological constraint costs money. Every time, the market was not built against you deliberately, but it was built for someone else, and the someone else it was built for has been optimizing their position inside it for a very long time. If what we just covered explained something you have felt every time you checked your brokerage account, stay with me, because understanding who the market was built for is one thing. The one approach that actually works for retail investors, that consistently outperforms active stock picking over time. That is what comes next. Here is the specific behavior pattern that destroys retail investor returns more than any other single factor. It is called performance chasing, and almost every retail investor does it. Performance chasing is the tendency to invest in assets that have recently performed well. It feels rational. Something went up. It must be a good investment. I should buy it. But here is what the data shows. Assets that have recently performed exceptionally well are statistically more likely to revert toward average performance than to continue their exceptional run. The very thing that made the investment feel safe, its recent strong performance, is actually a signal of elevated risk, not a signal of safety. The retail investor who buys after a strong run often buys near the peak. When the reversal comes, they experience losses, and then they sell, locking in those losses, and the cycle repeats with the next exciting opportunity. A research firm called Dalbar has studied retail investor behavior for decades. Their research consistently shows that the average equity fund investor earns significantly less than the funds they invest in actually return. The fund returns more than the investor earns from it, because the investor buys after strong performance and sells after poor performance. The behavior destroys the return. Now layer on top of this the media environment retail investors operate in. Financial media has a structural incentive to produce content that generates engagement. Fear and excitement generate engagement. Calm patient long-term holding does not make good television. So retail investors are continuously exposed to content that triggers exactly the emotional responses, fear and greed, that destroy investment returns. The media is not malicious. It is just optimized for engagement, and engagement happens to require the same emotional states that cost retail investors money. The environment was not designed to help you hold patiently. It was designed to keep you watching. Those two things are almost always opposites. Here is what actually works, and it is almost insultingly simple. After everything we just covered about institutional advantages, information edges, and behavioral traps, the approach that consistently outperforms the vast majority of active investors over long periods is to stop trying to beat the market and simply own it. A low-cost broad market index fund gives you ownership of a small piece of every major company in an index. When the index rises, you rise with it. You do not need to predict which company will perform best. You do not need to time the market. You do not need information that institutional players have, and you do not. You simply need exposure to the aggregate growth of the economy over time, and the data on this is extremely clear. Over 15 or 20-year periods, low-cost index funds outperform the majority of actively managed funds, including funds run by professional investors with every advantage we discussed. Not because index funds are clever, because they remove the behaviors that destroy returns. No performance chasing, no panic selling, no emotional response to financial media, just consistent ownership of the market across time. The institutional players' greatest advantage over you is information and speed, but those advantages only matter if you are trying to beat them at their game. If you are not trying to pick individual winners, their advantages become irrelevant. You stop competing. You start compounding. That is the only game retail investors consistently win. The stock market was not built for you, but it can still work for you. Not by beating institutional players at their game, not by picking winners, not by timing the market, by owning the market consistently, patiently, for long enough. That time does the work that information and speed cannot buy. That is the only edge available to a retail investor. And it turns out, it is enough. Share this with one person who has ever felt like the market was rigged against them. And if you want to keep understanding the financial systems built around your behavior, subscribe to Hidden Truth Files. Every week, hidden no more.